Well, hey there. We've managed to string together 3 whole consecutive days of live broadcasts here from the Insurance Pro Blog. I am Brantley Whitley, and I think if I point, nope, I still can't get that right. That's Brandon Roberts over
Do
there.
not point in the direction that you want to. Go against your instincts.
Exactly. Just go everything against your instinct and point the other way. So we're here today for the third time coming to you live. We're going to talk about another fascinating aspect of cash value life insurance. Today, it's not going to be specific to whole life insurance per se, but you will want to stay tuned because this is something that is a hot topic. This is something that we get asked about all the time. But first, a little shameless plug here. You should go over to ipblive.com. That's Insurance Pro Blog Live, or at least that's what the IPB stands for. ipblive.com. You can read all about our book, Predictable Profits, the 5 reasons your clients actually want to buy a whole life insurance. You can learn everything you ever wanted to know there. So, Brandon, what talk about today?
We're going to talk about the cash value enhancement feature of life insurance policy. So that's
Could also be called a liquidity rider at times.
Yep. Or, and we're lumping in there higherly cash value products. So okay. Whole life index universal life insurance, some current assumption universal life insurance policies do have a version of higherly cash value, or as you mentioned, a liquidity rider or whatever else have you. Right. And we're talking about these features because you and I have spent a lot of time in the past decade of our professional lives talking about building life insurance policies specifically focused on maximizing the cash value, correct?
Right, absolutely. So one would thereby think that we're big fans of liquidity riders or cash value. What did you cash surrender value enhancement? I can't even get them right. Enhancement riders. I mean, the logic.
Perhaps your inability to say it kind of jumps to the punchline a little too quickly.
No, so logic would follow that.
Yes, that we're in love with these things. We would use them on every single policy that we would ever design and put in place, but that assumption is incorrect. And the reason that assumption is incorrect is because these features focus in on a specific objective that is different from what we are seeking to do.
Okay. And what's that?
The objective that these features focus in on is taking care of concerns that somebody, more specifically business owners in most cases, would have with the lack of cash value in the first couple years of a policy. So let's kind of set the stage with a scenario. Let's say I'm the agent, you're the successful business owner, and I've come to you to talk about your business and talk about the work I do. And in that process, we've uncovered the fact that you have a couple of key employees that you really like. They're really integral to what you do, and you're hoping they don't go away. So you would like to offer them an additional compensation package that no one else is going to have but them. And what it's going to do is tie them to your company and kind of make them stick around. And if they leave, they're going to forfeit this benefit.
Okay.
Sounds great, right?
This is the proverbial golden handcuffs.
Exactly. Sounds really good. You need a way to fund this.
Right.
And there are a multitude of different options, but we talk about life insurance because life insurance will provide you a very flexible way to put money into the policy in terms of you can do whatever you want. Right. It'll build the cash that you'll need to fund the benefit that you're creating, the obligation that you're creating to these employees. It'll also give you a death benefit to recoup the expense when they die.
Right.
So you decide this is great. The only problem that you have is when I present to you the life insurance policy, you look at the first couple of years and you kind of sit there and look at it and go, this is kind of risky for me to put this kind of money out. And what happens if they decide to leave? And then I got to either keep putting money in here to try and get my money back or walk away at a loss.
Right. So in that, I just want to ask you a clarifying question there. That usually comes because someone or the business owner at that point is looking at the ledger, as we refer to it, that tells you how long we've been around, but the life insurance illustration, and they may see something like, well, I'm putting, $50,000 a year into this policy for this future obligation, right? But I see when I look over in the cash value column, it looks like there's only $25,000 in there.
It
after
could
the
be
first
that,
year. Or it could be worse.
It could be worse, right? So you look at that and you go, that doesn't sound like a very good idea. So I come back to you with the cash value enhancement rider. And that shows you that you put that $50,000 in there and you've got $50,000 of cash year one.
Right.
Or $48,000 of cash year one.
Sure.
Whatever the number is, because some of these things differ depending on the product and the company and the feature. So that makes you much more comfortable with moving forward using life insurance as the mechanism to fund this plan.
Right.
But it comes at a cost. That cost is that policy will not perform as well 10, 15, 20, 30 and beyond years out as it would have if that rider wasn't there. But you don't care about that because you're worried about the risk that you face now. And you know that you're just trying to capitalize the amount that you need to fund the obligation.
Right.
You're not seeking to optimize every last dollar that you can possibly get out of this policy 40 years down the road.
Right. Right. You're just very focused on the immediate term.
You and I focus on people who are buying policies for themselves individually in most cases.
Right.
And they are seeking to optimize every last dollar that they're going to get out of this thing for their entire lifetime.
Right.
So to go to them and show them a product that is either using a cash value enhancement rider or is a higher cash value product, yes, we'll have much more cash in the very beginning. But that comes at the serious loss of value later on.
Right.
And that, for them, over their lifetime, significantly diminishes what they can get out of life.
Right.
You and I know that there is a multitude of benefits that one can derive from life insurance. Focused on tax efficiency, death benefit, flexibility of funding, flexibility of taking money in and out of the policy and using it for a number of different goals.
Right.
We seek out the ability to optimize every dollar we can generate from the policy. And we seek to do that over a very long time period.
Right.
So our focus is not the same focus as these cash value enhancement riders or higherly cash value products. We're not seeking to squeeze out a couple of extra basis points in the first 1, 2, 3 years for somebody who wants to put money into a life insurance policy. If that's your objective, you should probably go shop CD rates at banks.
Right. Right. Well, it's not that it's a bad thing. It's just that everyone needs to understand that all of these components have their place.
Yes.
And what we're typically doing for a client, though it may seem like the cash surrender value enhancement rider would be the right choice, what you're really doing is you're giving up long-term cash in terms of the aggregate amount of cash value that you're going to have, and you're also giving up future ability to generate income if that's a
big one. That's a big one for people.
Absolutely.
The more cash you're going to generate in a policy 50, 60 years down the road. And sometimes when we talk to people, they lose sight of this because they're looking at, okay, what's the return on the cash by the time I'm 60?
Right.
And lots of times people like to focus in on that time frame, 60, 65. Like, let's look at the internal rate of return on these policies at that point. And I've always argued that we want to look at what it's going to be at age 85 or 90, because if we're going to take income from this, the larger cash value balance is going to give us more income when we start to use the policy for income, if that's the objective. I'm not going to dive into why that is today. Then we'll save that for another day. But just understand that we want to focus on cash not only at 10, 20, 30 years, but also 50, 60, and whatever number we get to when somebody's going to be in their 90s or 80s or something along those lines.
Right. Really briefly, I know this is probably not something you are planning on talking about here, but just want to bring up this point because I know that it comes up, and that is if life insurance companies can do things this way, in other words, if they can actually provide this sort of liquidity early on into a policy, why would they not do that across the board? And what makes it different than a policy that doesn't have this, that's able to generate more cash long term? Does that, am I being clear on that? Like, I'm asking you
You
to
are?
talk about sort of internally what's going on there.
You are, but I know we try to keep this to 10 minutes because
Yeah.
the current service we're using to do that tells us that we've got some sort of 10-ish minute line in the sand, which we have hit. So how about we put a pin in that and everybody knows that the
Okay.
next time they see us talking on Facebook, that's what they'll get to hear about.
Oh, well, that sounds good to me. Again, if you like what we're doing here and you feel compelled to support us, the best way you can do that is go over to ipblive.com, read all about our book, Predictable Profits, and find out all of the awesome bonuses that we have to give you there. We hope to be here soon. I don't think we'll be here tomorrow because I think schedules conflict there, but we will be back next week. Thanks so much, guys. Have a great day.